Imagine you're a real estate developer setting out to build this massive state-of-the-art skyscraper.
Okay, I'm with you.
You spend months working with architects on the perfect design, right?
Right.
You source the highest grade steel, the, most energy efficient glass.
Right, you've optimized every single physical element going into the construction.
Exactly. You have curated the absolute perfect mix of building materials. But then, and this is the kicker, you take all those brilliant blueprints and premium materials and you build the skyscraper on a piece of land that's zoned over a literal sinkhole.
Oh, wow. Yeah, that's a disaster.
Right. I mean, suddenly it doesn't matter how strong the steel is or how beautiful the glass looks. The foundation is sinking, the structural integrity is just compromised, and the value of your multi-million-dollar project is evaporating right into the mud.
It's a really painful image, honestly, but it captures the exact dynamic we are analyzing today. Because investors spend massive amounts of time obsessing over the materials of their portfolios, right?
Mm-hmm.
Picking the right stocks, analyzing bond yields, evaluating mutual funds.
Right, the stuff that goes into the building.
Exactly. But they spend almost no time thinking about the zoning, like the actual financial real estate where they are placing those investments.
And that oversight is the core of our deep dive today. We're exploring a really comprehensive guide to Asset Location 101.
It's such an important topic.
It really is. The source material for this actually comes to us from Thomas Davies of Davies Wealth Management. They're a fee-based fiduciary advisor located in Stuart, Florida.
Right.
And this guide is part of their broader 1715 Treasure Coast Financial Wellness Educational Series.
And, the central thesis of their material is pretty eye-opening. It reveals that where you hold your investments can actually be just as consequential to your long-term wealth as what you invest in.
Yeah, so for you listening, if you have assets spread across different types of accounts, say a 401k from an employer, maybe a personal brokerage account, and a Roth IRA, paying attention to this strategy can unlock substantial hidden wealth for you.
Absolutely.
And the best part is, you can capture this extra money without changing your investment risk by a single %. I mean, it is easily one of the most overlooked tools in wealth management. Okay, let's unpack this.
Let's do it.
Before we dive into the specific account types, we really have to draw a hard line between two terms that sound identical but perform completely different functions.
Yeah, people confuse them all the time.
Right. Asset allocation versus asset location.
The terminology definitely trips people up. So asset allocation, which is the concept most investors are already highly familiar with, is about the ratio of your investments.
Like the percentages.
Exactly. It's the strategic decision that your portfolio should be, say, 60% equities for growth and 40% fixed income for stability. Allocation is deciding what to build. Are you building commercial high-rises, residential apartments, industrial warehouses? You need a diversified mix to balance your risk.
I like to think of it with a grocery analogy. Like, asset allocation is deciding what groceries to buy at the store, right?
Mm-hmm.
You're picking out ice cream, cereal, vegetables.
Okay, I see where you're going with this.
But asset location, on the other hand, is taking those groceries and deciding where to store them when you get home.
Right.
Because if you put the ice cream in the pantry instead of the freezer, it melts.
That's a great way to put it.
Right, just like returns melting away to completely unnecessary taxes.
Yeah.
In the financial world, putting an investment in the wrong tax zone means your returns are steadily siphoned off.
And the drain on your returns is just relentless. The source material actually provides a brilliant mathematical breakdown of this to show just how much wealth is lost.
Oh, I love the math examples. Walk us through it.
Okay, so take a high net worth family sitting in the 37% federal income tax bracket. Let's say they have $500,000 invested in a portfolio of high-yield corporate bonds. If they locate those bonds in a standard taxable brokerage account, the IRS treats every single dollar of interest those bonds generate as ordinary income.
Ouch.
Yeah, so it gets taxed at their top marginal rate of 37%.
So let's run that math really quick. If those high-yield bonds are paying out, say, $25,000 a year in interest, that family is losing over $9,000 of that yield to federal taxes immediately.
Every single year, $9,000 just vanishes.
That's brutal.
But watch this. Now take those exact same high-yield bonds. Don't change the asset, don't change the risk profile, simply locate them inside a traditional IRA.
Which is a tax-deferred zone.
Exactly. The tax bill on that $25,000 of interest drops to absolute zero for the current year.
Wow, zero.
Zero. The interest stays in the account, reinvests, and it just compounds completely tax-free until it's eventually withdrawn decades later.
I mean, when you compound that extra $9,000 a year over like a 20-year timeline,
Yeah.
you aren't just talking about a minor efficiency anymore.
No, not at all.
You are talking about hundreds of thousands of dollars in difference purely based on where their asset lived.
It's massive.
But let me play devil's advocate for a second. Wait, if I'm just starting out, and I only have $200,000 in a single 401k, does any of this actually matter to me?
That's a fair question, and the source material is very clear on this. No, it doesn't. Asset location is largely irrelevant if you only have one account bucket.
Because you don't have anywhere else to put things.
Exactly. This is really a strategy for multiple accounts.
Got it. Well, most of you listening likely already have your assets spread across multiple accounts. You've progressed past the point of just having a single beginner 401k.
Right.
So at that level of wealth and complexity, how do we begin sorting these investments into the proper zones?
You have to start by understanding the specific rules of the three main real estate zones in your financial life. The first zone is the taxable account.
Okay.
This encompasses your standard individual brokerage accounts, joint investment accounts, and many trust accounts too.
So this is essentially the unzoned Wild West of investing. You have absolute freedom.
Absolute freedom. There are no contribution limits. The
Yes.
government literally does not care how much you put in,
Nice.
and there are no required minimum distributions forcing you to take money out, and no age penalties if you need to liquidate assets early.
So you can access your money whenever you want.
Yes, but, and this is a big but, that ultimate flexibility comes with a steep ongoing cost. Every single taxable event is recognized in the year it happens.
Right. So if a stock pays a dividend, you owe taxes this year.
Yeah.
If a mutual fund manager sells a stock inside the fund and distributes a capital gain to you, you owe taxes this year, even if you didn't sell the fund itself.
Exactly. Which means the taxable account is the ideal real estate for investments that are inherently tax efficient.
Okay, like what?
You want assets here that sit quietly and grow without throwing off a lot of taxable income. We're talking about broad market index funds, exchange-traded funds, and individual stocks that you intend to buy and hold for a decade or more.
Right, because when you hold those assets for longer than a year, any growth is taxed at the much more favorable long-term capital gains rates.
Yeah, typically 15 or 20%.
Right, which is way better than your ordinary income rate. But if you hold inefficient assets here, the penalty is severe. And the text highlights a critical warning for high earners specifically regarding this.
Oh, yes. The net investment income tax, or NIT.
Yeah.
If your modified adjusted gross income crosses a certain threshold, the IRS packs an additional 3.8% surtax onto your investment income.
Just to twist the knife a little.
Pretty much. So if you are holding tax-inefficient assets like those corporate bonds throwing off ordinary income or actively managed funds generating short-term capital gains, you're paying your top marginal rate plus that 3.8% NIT.
Wow.
Your tax drag can easily exceed 40% every single year.
That is just brutal. So if taxable accounts punish ordinary income so aggressively, where do we actually put the assets that naturally generate it?
Well, that brings us to the second zone, tax-deferred accounts. This is your traditional IRA, your standard employer 401k, or a 403b.
Okay.
Think of this like an enterprise zone. The government gives you a massive tax break up front, like you deduct the contributions from your current income, and then the investments grow without any annual tax drag.
So no taxes on dividends, no taxes on trades.
Right.
Yeah.
But the bill eventually comes due. It's really just a temporary shelter, because when you retire and start pulling that money out, every single dollar is taxed as ordinary income.
No matter what kind of growth it was.
Exactly. The wrapper dictates the tax treatment. Even if the growth inside the IRA came from what would have been a long-term capital gain in a taxable account, the IRA converts it all to ordinary income upon withdrawal.
Man, that's tricky, which I guess dictates exactly what belongs in this zone.
It does. You only want to place assets here that would have cost you a fortune in annual taxes anyway. This is the perfect home for those high-yield bonds we discussed.
Makes sense.
And it's also the optimal location for TIPS Treasury inflation-protected securities.
Oh, the mechanics behind tips are really fascinating, and they illustrate this concept perfectly.
They really do.
Because, the principal value of a TIPS bond adjusts upward with inflation, but the IRS taxes that upward adjustment in the year it happens, even though you don't actually receive that money until the bond matures.
Right. They call it phantom income.
Phantom income. You literally owe taxes on money you haven't touched yet. It's crazy.
It is crazy. But by locating TIPS inside a tax-deferred IRA, that phantom tax problem is completely neutralized.
Oof, gone.
Yep. And what's fascinating here is how this identical logic applies to REITs real estate investment trusts.
Oh, REITs are a great example.
Yeah, because by corporate design and tax law, a REIT is required to distribute at least 90% of its taxable income to shareholders every single year.
So if you hold a REIT in a taxable brokerage account, you are just hit with a tidal wave of ordinary income tax bills year after year.
It is incredibly tax inefficient. But slide that exact same REIT into a traditional IRA, and it's perfectly insulated.
Right.
The income pours in, it automatically reinvests, it compounds, and you don't pay a single cent in taxes until you take a distribution in retirement.
Love that. Okay, then we arrive at the third zone, the exclusive gated community of the financial world. Tax-free accounts.
The best neighborhood in town.
Exactly, the Roth IRA and the Roth 401k. You fund these with after-tax dollars. You pay the toll up front.
Right.
But the permanent reward is massive. Every dollar of growth, every dividend paid, and every withdrawal you ever make is completely tax-free forever.
Forever. And adding to their power, Roth IRAs do not have required minimum distributions during your lifetime.
Which is huge.
It's massive. The government never forces you to take the money out.
Right.
You can let the assets compound untouched for decades. Because of this unparalleled tax treatment, the source material explicitly refers to Roth accounts as the most valuable real estate in your portfolio.
So let me ask you this. If the Roth zone is this ultimate tax-free paradise, why are we bothering with the other zones at all?
I get that question a lot.
Right. Why don't we just put absolutely everything in there and never pay taxes again?
Well, because that prime real estate is strictly finite. The IRS places pretty heavy caps on how much you can contribute to a Roth account each year.
Ah, right.
And for high earners, direct contributions are often phased out entirely.
So you can't just dump $1 million in.
No, exactly. Now, there are advanced strategic workarounds like backdoor Roth contributions or mega backdoor Roth 401k strategies, but ultimately, your total Roth space is a precious, limited commodity.
Which means we have to be ruthless about what gets to live there.
Absolutely ruthless.
The guide makes the strategy really clear. The Roth zone is reserved exclusively for your highest growth investments. You want your small cap equities, your emerging market funds, the aggressive growth stocks that are meant to compound exponentially over a 30-year timeline.
Just think about the underlying math there. If you have an asset that is going to grow by, let's say, 500% over the next 2 decades, you want all 500% of that massive dollar growth occurring in the account that has a 0% tax rate.
Exactly. Okay, that covers the basic zoning laws. But the source material transitions into what happens when an investor's financial life scales up.
Yes, the high net worth difference.
Right. We go from simply sorting a few mutual funds to coordinating this massive, highly complex financial machine.
And the leap in complexity is staggering, but honestly, so is the payoff.
Yeah.
Like, a retail investor with a single 401k needs standard asset allocation advice. But consider a high net worth investor with, say, $4 million spread across a joint brokerage account, a rollover IRA from an old job, a Roth IRA, a current 401k, and perhaps a specialized trust account.
That's a lot of moving parts.
Exactly. They don't just have one decision to make. They have dozens of interconnected decisions to coordinate across different tax codes, different time horizons, and entirely different estate planning goals.
And getting those interconnected decisions right is incredibly lucrative. The source actually cites Vanguard's Advisors Alpha research, which quantifies this exact strategy.
It's a great study.
Vanguard found that tax-efficient planning, with asset location as a core component, can add roughly 0.75% in annual after-tax return to a portfolio.
Now, I know 0.75% might sound like a rounding error in isolation.
Sure.
But let's apply it to that $3 million portfolio. That translates to $22,500 in pure extra after-tax money every single year.
And that isn't just a one-time bonus. That $22,500 stays in the portfolio and it compounds.
Yes.
Over a 10 or 20-year timeline, you're looking at hundreds of thousands of dollars in additional wealth generated without taking on a single ounce of additional market risk. It's pure structural alpha.
Which is exactly why high net worth families rely on advanced coordination strategies like Roth conversion ladders.
Walk us through that.
So conversion ladder is a strategic multi-year process where you intentionally move money from your tax-deferred traditional IRA into your tax-free Roth IRA. You execute this during years when your income, and therefore your marginal tax bracket, is unusually low. This typically happens right after you retire, but before you start taking Social Security or are forced into required minimum distributions.
And the asset location piece is really the engine of that strategy, right?
Totally.
Because the order in which you convert those assets dictates the success of the latter. You want to selectively convert the assets with the highest expected future growth first.
Yes, get them in the tax-free zone early.
Right. You pull them out of the deferred zone and lock them into the tax-free zone right before they experience massive appreciation. But here's where it gets really interesting. You can't just blindly convert massive chunks of your IRA.
No, you cannot.
Because you might trigger a devastating hidden trap called IRMAA.
And if we connect this to the bigger picture, IRMAA, which stands for the Income-Related Monthly Adjustment Amount, is the ultimate example of why financial planning cannot happen in isolated silos.
It's so true. Walk us through the mechanism of this trap. Like, how does a tax strategy accidentally blow up your healthcare costs?
Okay, so when you perform a Roth conversion, the IRS treats the amount you converted as taxable ordinary income for that specific year.
Right.
If you convert a large sum, you artificially spike your modified adjusted growth income, or MGI, and Medicare uses your MGI from 2 years prior to determine your Medicare Part B and Part D premiums.
Oh, I see where this is going.
Yeah. If your Roth conversion pushes your income over the strict IRMAA thresholds, Medicare slaps you with massive surcharges.
So by trying to optimize your tax bill, you suddenly find your Medicare premiums doubling or tripling.
Exactly.
We're talking about thousands of dollars in extra healthcare costs simply because the tax strategy wasn't coordinated with the healthcare timeline.
It completely undermines the tax savings you were trying to achieve in the first place.
Right.
And this need for intense coordination gets even more intricate for corporate executives or, business founders who hold concentrated stock positions.
Oh, definitely.
If you have a massive chunk of employer stock inside your 401k or highly appreciated restricted stock units, traditional advice says to just cash it out and diversify. But if you do that, you just get slaughtered by ordinary income taxes.
Let's focus on that scenario for a second, because it's incredibly common for a lot of you listeners in the corporate world.
Oh yeah, we see it all the time.
You spend 20 years at a company, you accumulate a massive position of company stock inside your 401k. If you just roll that stock into a traditional IRA and sell it, or, withdraw it as cash, you are paying top-tier ordinary income tax on the entire amount.
Which is painful.
So what is the mechanism to bypass that?
Well, the guide highlights a powerful, highly specific tax code provision called NUA, or Net Unrealized Appreciation.
Okay.
NUA allows you to separate the original cost of the stock from its massive growth. So instead of rolling the company stock into an IRA, you distribute the actual shares directly into a taxable brokerage account.
Wait. If I pull assets out of a 401k into a taxable account, doesn't that trigger a massive tax bill immediately?
Well, this is where the NUA mechanism is brilliant. When you make that transfer, you only pay ordinary income tax on the cost basis.
Which means?
The original price the shares were purchased for years ago.
Oh, wow.
Right? All of the growth, the massive appreciation that happened over decades is classified as net unrealized appreciation. You pay zero tax on that growth at the time of the transfer.
That is wild.
And then later, when you finally sell those shares in the taxable account, that NUA is taxed at the highly favorable long-term capital gains rate, saving you tens of thousands of dollars compared to ordinary income rates.
That is an incredible loophole. But what if the concentrated stock isn't in a retirement account? Like, what if an executive just has millions of dollars of highly appreciated stock sitting in a regular brokerage account?
That's a different beast entirely.
Because if they sell it to diversify, they're hit with a massive capital gains bill instantly.
Right. So in that location, you utilize a different set of tools, like a charitable remainder trust or CRT.
Okay, what is that?
A CRT is an irrevocable trust. You transfer your highly appreciated, low-basis stock directly into the trust. And because the trust itself is a tax-exempt entity, it can sell that concentrated stock and owe absolutely zero capital gains tax.
So the trust sells the stock, bypassing the IRS completely, and then reinvests the full pre-tax amount into a diversified portfolio.
Exactly.
But how does the investor actually get their money back?
The trust is legally structured to pay you, the investor, a calculated income stream for the rest of your life, or, for a set term of years.
Ah, okay.
You receive steady income from the diversified assets, the initial capital gains tax is bypassed, and when you eventually pass away, the remainder of the trust goes to a charity of your choice.
Very smart. But what if an investor doesn't have charitable intent, but still needs to exit a massive stock position without triggering taxes?
Then they might utilize an exchange fund.
How does that work?
This is a mechanism where you take your concentrated stock and pool it into a partnership with dozens of other executives who hold different concentrated stock.
Okay.
You contribute your shares, they contribute theirs. You receive a pro rata share of the newly created diversified pool. And because you are contributing to a partnership rather than selling the stock, it's not considered a taxable event.
Wow, so you achieve instant diversification while permanently deferring the capital gains tax.
Exactly right.
The underlying theme here is that generic advice just won't tell you to do any of this. Generic advice assumes all assets are treated equally by the IRS.
Which they absolutely aren't.
Right. And that leads to common, highly disruptive errors. The text outlines a series of prevalent mistakes that regularly drain wealth from uncoordinated portfolios. Let's examine the mechanics of where investors go wrong.
Mistake number one is holding municipal bonds inside a Roth IRA.
Oh, this one hurts to even think about.
Right. We established how precious and finite Roth space is. The entire appeal of a municipal bond is that its interest is already federally tax-exempt by law.
So if you locate a municipal bond inside a Roth IRA, you're wasting the ultimate tax-free shelter on an asset that already shields itself from taxes.
You are burning your most valuable real estate for zero additional benefit.
It's like putting sunscreen on while you're indoors.
Yes, perfect analogy.
Hmm.
And mistake number two is keeping high turnover, actively managed mutual funds in a taxable account.
Okay, tell us why.
If a fund manager is constantly buying and selling stocks inside the fund to chase returns, every one of those internal sales generates a capital gain. By law, those gains are passed on to you, the shareholder.
So if that fund is in your taxable account, you owe taxes on those internal gains every single year.
Yep. You could literally be forced to pay taxes on a fund in a year where the fund's overall value actually went down simply because of the internal turnover.
That's infuriating. So those highly active funds must be locked in a tax-deferred or tax-free zone.
Without a doubt.
Now let me throw one more scenario at you. Let's say I have a taxable brokerage, a 401k, and a Roth IRA. Shouldn't I just be like a responsible, disciplined investor and make sure every single one of those accounts is perfectly diversified? Like if my target allocation is 60% stocks and 40% bonds, shouldn't I put a 60-40 mix in the taxable, a 60-40 mix in the 401k, and a 60-40 mix in the Roth?
Absolutely not. That is mistake number 4. And it might honestly be the most common wealth-destroying habit of all. Treating your accounts as independent, standalone portfolios.
Explain why that fails so drastically.
Well, if you force a 60-40 mix into every single account, you are mathematically guaranteeing that you will hold tax-inefficient bonds in your taxable account.
Right.
And you're guaranteeing you will hold low-growth fixed income in your Roth account, which just wastes its tax-free compounding power.
Which completely destroys the entire concept of asset location.
Exactly. You must stop viewing your accounts as separate entities. You have to view all of your accounts as one single, unified mega portfolio.
So you look at the big picture first.
Right. You determine your overall allocation, say 60% stocks and 40% bonds total across your entire net worth. Then you ruthlessly locate those assets into the specific accounts where they're treated best by the tax code.
So all the bonds go to the traditional IRA.
Yes.
All the high-growth stocks go to the Roth.
Exactly.
And all the broad index funds go to the taxable.
You've got it. It operates as one cohesive machine.
I mean, that is a complete paradigm shift from how most people are taught to invest.
It really is.
And as we wrap this up, there is one final pivot the text makes. It takes this entire concept and elevates it from lifetime wealth preservation to multi-generational legacy planning.
Yes, this involves the concept of the step-up in basis.
Such a huge topic.
This legal mechanism completely rewrites the rules of asset location when you are planning for what happens to your wealth after you pass away.
Walk us through how this step-up mechanism actually functions, because it is incredibly powerful.
Okay, so when you hold a highly appreciated asset in a taxable brokerage account, say you bought a stock years ago for $50,000, and it has compounded and is now worth $1 million.
Okay, great investment.
Right. But if you sell it during your lifetime, you owe huge capital gains taxes on that $950,000 of growth.
Of course.
But if you hold that asset until you die and leave that taxable account to your heirs, the tax code grants a step-up in basis. The IRS magically resets the original purchase price of the stock to its market value on the exact day you died.
Wow. So for your children inheriting the account, the IRS acts as if they bought the stock for $1 million that very day.
Precisely. They can turn around and sell the entire position the next morning for $1 million, and they owe absolutely zero capital gains tax.
That's unbelievable.
That $950,000 embedded tax liability is completely legally wiped out.
And this is a massive flashing red warning light for estate planning. That step-up provision does not apply to a traditional IRA.
Correct. Assets held inside a tax-deferred traditional IRA get no step-up in basis upon death.
None at all.
None. When your heirs inherit that IRA, they don't just inherit the money, they inherit your deferred income tax liability.
Oh, wow.
And under current law, they are generally forced to drain that inherited IRA within 10 years. Every dollar they take out is taxed at their own ordinary income tax rate, which could be incredibly high if they are in their peak earning years.
Which means if you're holding your highly appreciated growth stocks in your IRA and your bonds in your taxable account, you are accidentally building a massive tax bomb for your children.
You really are. It's a huge issue.
But this raises a completely different provocative thought to ponder on your own after this deep dive. We've spent this entire time talking about the tax code as if it's written in stone.
Right.
But with national deficits rising and Congress constantly looking for revenue, how long before the government decides to rewrite the zoning laws entirely?
Yeah, this raises an important question about legislative risk. Like, what happens if Congress decides to eliminate this step-up in basis?
Right. Or what if they cap the tax-free growth inside Roth accounts or forced distributions regardless of age?
It's entirely possible. And if the rules of the real estate change, your allocation strategy has to adapt instantly.
Exactly. It illustrates why true asset location isn't just a one-and-done decision you make in your 30s and forget about.
No, not at all.
It has to evolve dynamically as tax laws change, as your income shifts, and as your estate planning goals mature.
And, that philosophy of constant coordinated evaluation is exactly what Davies Wealth Management in Stuart, Florida, builds their practice around.
Definitely. So if you realize today that you've been managing your accounts in isolation, you don't have to keep guessing. You can actually take the Davies Wealth Management Financial Wellness Quiz to spot the structural tax gaps in your current portfolio.
It's a great starting point.
Or better yet, you can book a discovery call with their team to finally view your entire financial picture through a single unified lens.
Because treating your wealth as a coordinated system, rather than just a pile of disparate accounts, is where genuine generational value is secured.
So what does this all mean for you? It means true financial wellness isn't found in a demographic template, and it isn't found in chasing hot stock tips. It is found in having an architectural plan built specifically for your situation, where every single asset you own is living in its optimal neighborhood.
Well said.
Don't let your multi-million-dollar portfolio sink in a tax swamp. Build it on the right foundation. Thanks for listening.